Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael siding. So in this deep dive of LVMH, let's take a look at warranted price earnings multiples, or actually in warranted DCF valuations. So last 12 months, I'm here at MoneyChimp Valuation DCF. So this is a free online resource where you can play around with various DCF assumptions and see what the warranted value is. And once you have the warranted value, you can also calculate what the warranted price earnings ratio is for the company. And as you can see here, I have entered a scenario based on 25.12 earnings per share. And what comes out of this mathematical DCF calculation, remember, a DCF calculation is simply a formula that estimates the present value of future cash flows given your assumptions of growth rates for an initial period and then the growth rate for the rest of time. And using a discount rate, which is your required annual return for valuing how much a dollar in the future is compared to a dollar today. And I think you should always use at least 15% discount rate, because if you get less than 15% per year for investing in a single stock, that's just simply not worth it. It's not an enough margin of safety. So let's just use this MoneyChimp valuation model and play around with it a bit. As you can see here, at 15% growth rate for the coming 5 years, and then an annual growth rate of 12% thereafter. This is probably somewhere where LVMH should turn up, although the coming 5 years is a bit harder to estimate, I would say, than the long-term growth rate, a bit paradoxically, but because of the tariff wars and we don't really know how much of the recent growth rate and profitability was due to more favorable environment after money printing. We also don't know when the next money printing paradigm is going to take hold, although I think that we are pretty close, within a year from getting serious monetary stimulus. But in order to get there, we must first have a crisis of sorts in order for the Fed and Trump to want to ride to the rescue and show their benevolence to the markets and thus make it even worse for the future. Anyway, so this is like the stock value per share, present value with these assumptions and a 15% discount rate. You can see it's like a more than 40 times warranted price earnings ratio. But let's change things around a little bit and say that the first 5 years are actually let's see if it can make no, it can't. Let's see. It cannot have negative years here, but let's say 5% annually for the next 5 years and then 12% thereafter. Then the warranted price is 691. And the actual current price right now for LVMH is 495. So even with a very slow rate for the coming 5 years, let's put in 0 and see what happens. Then we're at 550. So even if they don't grow at all in terms of earnings per share the coming 5 years, and then resume their 12% growth rate, and we have used a 15% discount rate, then it's still pretty good value at 495. Maybe not a huge margin of safety. It's only worth, let's say, like 10% more presently. But then remember, it also is baked into the cake a 15% annual return from the 550 level. And using this tool, you can also see if you keep track of the relation between the price and the EPS, you can keep track of what is a warranted price earnings ratio given a certain set of assumptions. And right here this is little more than, this is a 22 times warranted price earnings ratio given these assumptions. Let's say it's completely flat for 10 years before resuming a 12% growth rate. Well, oh no, there. Then we're down at 357. So if you think that LVMH is going to completely collapse in terms of growth and just be completely flat for 10 years, which is wholly unlikely, then maybe you could get down to 358 in a warranted valuation. This is not at all what I'm foreseeing. Even though I can definitely see that there will be a tough year or two. But what's interesting with this model is that you can let's say we do it a little bit more plausible. Let's say it's growing at 15% annually for 5 years. So that would be a 40 times warranted earnings ratio. But let's say that they go all the way down to 8% annual earnings growth after those 5 years. Then we end up at about where the company is trading right now. So remember, it's at about 485, 495 today. 513, I would say it's just about the same level. So if they grow at 15% annually for 5 years and then just 8% for eternity after that, then you can see that about a 20 times price earnings ratio is warranted. So this is what I'm talking about when I'm always referencing a likely annual EPS growth rate for a while or for the future, and how that is linked to how much the P/E ratio could be allowed to be. And this is something that over time it will become more natural for you to just make this the jump from growth rates to warranted price earnings level. But just you could keep in mind as a rule of thumb that since the average market historical warranted level is that if you pay 15 times earnings, then you have gotten a 10% total return from the market going forward from there. And that is based on actually an 8% earnings per share growth rate and a 2% dividend yield. And that's why you're getting a 10% total return from the market. And that's why 15 times earnings is a warranted level for the average stock in the index. So this is how you do when you're modeling how much it should be expected to be valued. So for example, you can use this to estimate what the type of stock the future will have in 4 years. So let's say you're now at 2025, imagining that you stand at 2029, and from 2029 you enter these various assumptions, and that will give you a warranted price earnings ratio standing in 2029, and that is your detailed estimate of a likely price earnings multiple at that point in time in 2029. So then all that's left, that's left is estimating what the earnings per share will be in 2029, using a little bit more nuance than just chart-based methods. So that is what we are going to do in the next video, adding a little bit more nuance to how we actually estimate fundamentals, not just chart-based, but actually going into the table of the actual numbers for the company.